Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Look at U.S. versus Australia, and you can see here U.S. rates here in black. You can see how low these are relative to Australia. Australia is a very high-yielding currency. That's why it's called a high yield or high-yielding commodity currency. So you can see that difference in spread definitely benefits the Australian dollar in a very, very big way. Again, part of our story, if we get through this global conflagration period and this risk period, we think ultimately the U.S. will move in a kind of a neutral bracket with the commodity currencies. At least that was part of our story. It's changing again a bit. But we think with Europe out of the picture, Japan out of the picture, and we think the debt problem in the UK is really more serious right now than people are at least giving credit for relative to its price action. We think on a relative basis, this yield differential will move up, will close a bit. The commodity currencies will still have a yield advantage over the dollar, but on a relative basis, the U.S. dollar with the commodity currencies will outrun the European currencies and Japan, again, once or if we get through this period. This is U.S. versus China. I just want to show this to you. China showing the yield curve not starting out here until about the 2-year time frame. What's interesting about this is, we have China growing at 10%, and yet their yields are suppressed in 2 to 3% areas, which is really ridiculous, which just shows you how out of whack and how artificial the whole financial system is in China. And it's out of whack for a big way in order to liquefy and provide credit to their manufacturing base so they continue to build supply and capacity. So that's an interesting dynamic right there. In the real world, in not the world of China, given those growth rates and its little concern, slight concern on the inflation side of the fence and the free-floating currencies, these yields would be significantly higher. So they've suppressed and artificially suppressed yields in their currency to create credit in a very, very big way. And that's why you have a lot of credit dislocation in China. No doubt it's blowing and going, but there's been a lot of wasted credit because of this government. Anytime a government tries to steer credit to targeted industries, and China does it in a very, very big way, you have inefficiencies, corruption, and dislocation, and this may all rise to the surface pretty soon if the Chinese bubble breaks, as we talked about earlier. And this is all part and parcel to it. Foreign direct investment. This is gross fixed capital formation for the U.S. And this is kind of that stuff, plant and equipment. It's non-operating type stuff. It's non-financial stuff, and you can see how this just fell off a cliff here. Started to fall 2006, even before the credit crunch, but just ratcheted down, and we blip up and now turning over again, which doesn't bode well for the idea of a great recovery in the U.S. There's a view, of course, that there's no way we're going to have a double dip recession. We actually think the chances of a double dip are much greater than the economists think there are, because we're looking at stuff like this. We're looking at money supply that continues to fall. We're looking at reserve growth that just isn't changing at all. Money's not leaving the banks. So all this stuff, if we were to see any type of vibrant recovery in the U.S., this should have snapped back. And what this part of this is telling us is businesses that are flush with cash and still have good earnings. Part of the reason they have good earnings is they're not putting money to work in capital investment at all, and all that money is just going right to the bottom line. There's a lot of concern still out there in the world of some of the things we talked about. So again, capital investments aren't being made. When they do, this pent-up cash or pent-up capital spending, so to speak, again, is another driver for the U.S. dollar if it starts genning up in a big way. We think it's going to be, again, part of that process of self-reinforcing money flow if we get it. It's an open question as we move further here whether that's going to happen sooner or later. If we get into a double-dip recession, which we can talk about in a minute, this sure may not rebound and may go even worse here. Risk favors the world reserve currency. This chart, a little bit nasty looking, but let me try and explain it. The black line here is the S&P 500. The red line is the U.S. dollar index. The green line on the bottom, because I didn't have enough data for the Fed funds, is the 6-month Treasury yield in the U.S. And if we just follow and look at the U.S. stock market first in black, you can see how it's rolls down, rates coming down. This low in rates here in the 6-month yield was when the Fed, put its emergency interest rate on when Greenspan was in office. We had the break of the U.S. stock market in here. Remember the break of the NASDAQ in 2000 led to this emergency decline in interest rates in order to keep the world out of deflation, of deflation. This process right here and this basing and all this credit being created here was part and parcel to what led to the credit crunch. All those derivatives and trillions, hundreds of trillions of dollars in derivatives, it's not hundreds of billions, many trillions in derivatives were created and pumped out. And that was that dollar credit going out into the world. So this was kind of the raw material right here. And let me go back to this. Think of those low interest rates there. That was that raw material that led to this acceleration right here down in the U.S. current account. This acceleration was that U.S. dollar credit going out and funding every asset class in the world. And in the process of U.S. dollars going out into the world and funding every asset class, the dollar, of course, was the funding currency, went down, and every other asset class went up because there's a massive amount of dollar-based liquidity out there. And we also had that symbiotic relationship where China would sell goods to us. They would make money. They'd send it back into U.S. capital markets. We'd create more derivatives, buy more goods from China. They'd make more money. And we had that, that spiral, not a very pretty picture there, but that spiral of recycling of China reserves back into the U.S. economy, back in the U.S. capital markets. And it led to that massive growth in derivatives. And we know how it all ended badly. We just didn't quite know when it was going to end, but it ended, and it ended right here with the top in the U.S. stock market, which ultimately led to a bottom in the U.S. dollar, changed the dynamics. The credit crunch changed the dynamics. You saw it through the current account. You can see it through these charts, and now we have interest rates just crawling along here, trying to keep the world afloat. And of course, we know it's not stimulating in a way that it should. This recovery should be going along and just screaming relative to historical recoveries at this point in time, especially given how much money is being thrown at it. The fact that it's not tells us there's a structural change in the global economy, and we think that changes the dynamics of the currencies going forward in a big way. But what this chart shows, starting from this point on, again, where this massive credit started coming into the market, is the direct negative correlation between the U.S. dollar and the stock market. Stock market started to rally here. The U.S. dollar funded this rally. Credit crunch hit. Risk bid back into the dollars. People around the globe rushed out. Stock market crashed. Green shoots came in, refunding. Big move in the stock market. Pullback in the dollar. Now the dollar pulled back here and retraced about 80% of this low here. Let me get rid of this. Retrace about 80% of this low, and you may remember most people were saying another bear market in the dollar. We didn't expect it because we thought those dynamics were changing because of the credit crunch, and the improvement of the current account helped us make this call. And so all of a sudden you start to see the dollar and the stock market move together in a kind of interesting correlation together, and you're seeing this correlation now change in a big way. So it's something that we, in terms of our story, we have to be careful about.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.